Do you want to successfully complete the D076 Objective Assessment Exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the D076 OA Exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from agency cost, time value, Excel functions, business ethics, and risk return. So let's get started. 1. A company discovers its managers are creating unnecessary acquisitions to expand their personal power rather than focusing on shareholder value maximization. Which concept best describes this situation? A. Market efficiency. B. Agency costs. C. Time value. D. Risk diversification. Can you guess the answer? Correct answer, B. Agency costs. Explanation: option B is correct because agency costs arise when managers pursue personal interests that conflict with shareholder wealth maximization, causing real financial harm to company value. Option A is incorrect because market efficiency relates to how quickly prices reflect available information, not conflicts between managers and shareholders. Option C is incorrect because time value refers to the concept that money today is worth more than money in the future. Option D is incorrect because risk diversification involves spreading investments across different assets to reduce overall portfolio risk. Let's dive into understanding agency costs, a critical concept in corporate finance. Agency costs arise when there's a separation between those who own a company, the shareholders, and those who run it, the managers. Think of it like hiring someone to manage your property. You want them to maximize your rental income, but they might spend money on fancy office furniture for themselves instead. In corporations, managers might pursue projects that expand their personal power or prestige rather than focusing on what actually increases shareholder wealth. This creates real financial costs for the company. Agency costs explain why companies implement various controls and compensation structures to align manager behavior with owner interests. 2. Your manager asks you to evaluate a project using net present value analysis. Which Excel function would be most appropriate for calculating the present value of multiple future cash flows? A. PMT function. B. FV function. C. NPV function. D. Rate function. Do you know the answer? Correct answer, C. NPV function. Explanation: option C is correct because the NPV function calculates net present value by discounting a series of future cash flows to determine their worth today. Option A is incorrect because PMT calculates periodic payment amounts for loans or investments, not present values of multiple cash flows. Option B is incorrect because FV calculates the future value of an investment, moving forward in time rather than discounting. Option D is incorrect because rate calculates the interest rate per period, not the present value of cash flows. To really understand NPV functions in Excel, let's explore what makes them so powerful for investment analysis. NPV stands for net present value, and it's the Swiss Army knife of financial decision-making. When you have multiple cash flows happening at different times in the future, the NPV function does all the heavy lifting. It takes each future cash flow and discounts it back to today's value using your specified discount rates. Think of it as a time machine for money that tells you what all those future payments are worth right now. This is why NPV is superior to other functions, like PMT or FV, when dealing with multiple irregular cash flows. It handles them all in one calculation. 3. An employee at Wells Fargo created fake customer accounts to meet compensation targets without customer permission. This action primarily violates which fundamental business principle that affects multiple stakeholders? A. Financial leverage. B. Business ethics. C. Market liquidity. D. Capital structure. Can you guess the answer? Correct answer, B. Business ethics. Explanation. Option B is correct because creating fake accounts violates business ethics by breaching customer trust, damaging company reputation, and harming all stakeholders, including customers and shareholders. Option A is incorrect because financial leverage refers to using borrowed funds to increase potential returns on investment activities. Option C is incorrect because market liquidity measures how easily assets can be bought or sold without affecting market price. Option D is incorrect because capital structure involves the mix of debt and equity financing used by a company. Let's explore business ethics through the lens of the Wells Fargo scandal to understand its devastating impact. When employees create fake accounts without customer permission, they're not just breaking rules, they're violating the fundamental trust that makes banking possible. Business ethics isn't just about following laws, it's about maintaining integrity in every stakeholder relationship. The ripple effects are enormous. Customers lose trust and take their business elsewhere. The company faces massive fines and lawsuits. Employees lose their jobs, and the entire industry's reputation suffers. This is why ethical violations are so costly. They destroy value at every level of the organization and beyond. 4. A financial manager needs to determine how much to invest annually to reach a specific retirement goal. Which time value concept helps calculate the required periodic investment amount starting 1 year from today? A. Single sum. B. Perpetuity calculation. C. Ordinary annuity. D. Growing perpetuity. Do you know the answer? Correct answer, C. Ordinary annuity. Explanation. Option C is correct because an ordinary annuity involves equal periodic payments starting at the end of the first period, which is perfect for calculating the required periodic investment amount needed to reach a specific retirement goal. Option A is incorrect because single sum calculations involve one lump payment rather than periodic investments over time. Option B is incorrect because perpetuity calculations assume infinite payments, which is unrealistic for retirement planning with finite timeframes. Option D is incorrect because growing perpetuity assumes payments that increase forever, which is inappropriate for fixed retirement contribution planning. Alright, let's break down ordinary annuities and why they're perfect for retirement planning. An ordinary annuity is a series of equal payments made at regular intervals, with payments starting at the end of the first period. That's the key distinction. When you're planning for retirement, you need to save the same amount regularly, say monthly or annually, to reach your goal. The beauty of an ordinary annuity calculation is that it accounts for compound interest on all your deposits over time. Unlike a single lump sum investment or a perpetuity that goes on forever, an ordinary annuity matches real-world retirement saving perfectly, regular contributions for a defined period leading to a specific future value. Which approach would best help track actual spending against planned categories while maintaining flexibility for adjustments throughout the period? A. Static forecasting. B. Envelope method. C. Historical trending. D. Ratio analysis. Can you guess the answer? Correct answer, B. Envelope method. Explanation. Option B is correct because the envelope method allocates funds to specific spending categories while allowing daily expense tracking and budget revision as needed. Option A is incorrect because static forecasting creates fixed predictions that cannot adapt to changing circumstances during the period. Option C is incorrect because historical trending analyzes past data patterns but does not provide active spending control mechanisms. Option D is incorrect because ratio analysis evaluates financial relationships, but does not track spending against budget categories. To understand the envelope budgeting method, imagine having physical envelopes for each spending category. The envelope method is brilliant in its simplicity. You allocate your income into different spending categories at the start of each period, just like putting cash into labelled envelopes. When you spend, you track it against that category's allocation, and when the envelope is empty, you stop spending in that category. This method provides real-time visibility into your budget status and forces discipline, because you can't overspend what you don't have allocated. The flexibility comes from being able to adjust allocations between periods based on actual spending patterns, making it both rigid enough to control spending and flexible enough to be practical. 6. A manager must choose between two investment projects with different risk levels. What principle suggests that higher risk investments should provide higher expected returns to compensate investors? A. Accounting equation. B. Risk-return trade-off. C. Double entry. D. Matching principle. Can you guess the answer? Correct answer, B. Risk-return trade-off. Explanation: option B is correct because the risk-return trade-off principle states that potential returns rise with increased risk, requiring higher compensation for riskier investments. Option A is incorrect because the accounting equation balances assets with liabilities and equity, unrelated to investment risk decisions. Option C is incorrect because double entry is an accounting method recording each transaction in two accounts simultaneously. Option D is incorrect because the matching principle aligns revenues with related expenses in the same accounting period. Let's examine the risk-return trade-off, one of the most fundamental principles in all of finance. The concept is elegantly simple, yet profoundly important. Investors are risk-averse, meaning they don't like uncertainty, so they demand compensation for taking on risk. Think of it like this. If someone offers you a guaranteed $100, or a coin flip for either $0 or $200, most people take the sure thing, even though the expected value is the same. In investing, this means that riskier investments must offer higher expected returns to attract investors. If two investments offer the same return, but one is riskier, any rational investor chooses the safer option. This principle drives everything from personal investment decisions to corporate capital budgeting. 7. Your firm wants to align management interests with shareholder interests to reduce agency costs. Which compensation strategy would most effectively achieve this goal while minimizing conflicts of interest? A. Fixed salaries. B. Cash bonuses. C. Stock ownership. D. Expense accounts. Do you know the answer? Correct answer, C. Stock ownership. Explanation: option C is correct because stock ownership compensation aligns manager and shareholder interests because managers benefit directly when company value and stock prices increase. Option A is incorrect because fixed salaries provide no incentive for managers to maximize shareholder wealth or company performance. Option B is incorrect because cash bonuses can encourage short-term thinking that may harm long-term shareholder value. Option D is incorrect because expense accounts are perks that do not align manager decisions with shareholder wealth maximization. Now let's understand why stock ownership is the gold standard for aligning manager and shareholder interests. When managers own stock in their company, something magical happens. Suddenly, every decision they make affects their own wealth directly. If they make good decisions that increase company value, their stock becomes more valuable. If they waste money or pursue vanity projects, they're literally destroying their own wealth. This is fundamentally different from fixed salaries, which pay the same regardless of performance, or cash bonuses, which can encourage short-term thinking. Stock ownership creates a long-term partnership mentality where managers think and act like owners because they are owners. 8. When using Excel for financial analysis, you need to calculate how long it will take an investment to double. Which function would help determine the number of periods required given a specific interest rate? A. IRR function. B. EMPA function. C. PV function. D. Type function. Can you guess the answer? Correct answer, B. EMPA function. Explanation. Option B is correct because the EMPA function calculates the number of payment periods needed to reach a financial goal given specific rate conditions. Option A is incorrect because IRR calculates the internal rate of return for cash flows, not the time periods required. Option C is incorrect because PV calculates present value of future cash flows, not the number of periods needed. Option D is incorrect because type specifies when payments occur within periods, not how many periods are required. Let's explore the EMPA function and why it's perfect for answering how long questions in finance. EMPA calculates the number of periods needed to reach a financial goal given a specific interest rate and payment structure. Imagine you wanted to double your money at 7% annual interest. EMPA tells you exactly how many years it will take. This is different from IRR, which finds a rate, or PV, which finds a current value. NPR is specifically designed to solve time-based questions, making it invaluable for retirement planning, loan payoff calculations, and investment horizon decisions. It's like having a financial GPS that tells you not where you are, but how long your journey will take. 9. A company discovers that its managers are spending money on wasteful projects that do not benefit shareholders. This behaviour represents which type of cost that reduces firm value and shareholder wealth? A. Operating costs. B. Agency costs. C. Sunk costs. D. Fixed costs. Do you know the answer? Correct answer, B. Agency costs. Explanation. Option B is correct because agency costs occur when managers pursue projects that benefit themselves rather than maximising shareholder wealth and firm value. Option A is incorrect because operating costs are normal business expenses required for daily operations and revenue generation. Option C is incorrect because sunk costs are past expenses that cannot be recovered, regardless of future decisions made. Option D is incorrect because fixed costs remain constant, regardless of production levels or business activity volume changes. Let's dig deeper into agency costs and why they represent such a serious drain on company value. Agency costs are the real economic losses that occur when managers pursue their own interests instead of maximising shareholder wealth. These aren't just theoretical concerns, they show up as actual wasted money on empire-building acquisitions, luxurious corporate perks, or avoiding profitable but risky projects to protect job security. The key insight is that these costs are different from normal operating expenses, which create value, or fixed costs, which are necessary for business. Agency costs are pure deadweight loss, value destruction that benefits no one except the self-interested manager. This is why corporate governance and proper incentive structures are so critical. 10. Your supervisor asks you to create a financial forecast using historical data patterns. Which budgeting component would be most critical for projecting future cash flows based on past performance trends? A. Zero-based. B. Activity-based. C. Historical analysis. D. Incremental approach. Can you guess the answer? Correct answer, C. Historical analysis. Explanation. Option C is correct because historical analysis examines past financial data patterns to identify trends that help predict future cash flows and performance. Option A is incorrect because zero-based budgeting starts fresh each period without considering historical spending patterns or trends. Option B is incorrect because activity-based budgeting focuses on cost drivers of activities rather than historical trend analysis. Option D is incorrect because the incremental approach adjusts prior budgets by percentages without analysing underlying historical data patterns. To understand historical analysis in budgeting, think of it as being a financial detective looking for patterns. Historical analysis examines your past financial data, revenues, expenses, seasonal variations, to identify trends that help predict the future. Unlike zero-based budgeting that starts fresh each period, historical analysis leverages the valuable information in your past performance. For example, if your sales always spike 40% in December, you'd better plan for that in next year's budget. This method is particularly powerful because it's based on actual data, not guesses. It's like using a weather pattern from the past 10 years to predict next year's weather. Not perfect, but far better than random guessing. 11. An investor wants to know the current worth of receiving $10,000 5 years from now. Which time value of money concept directly addresses this calculation need? A. Future value. B. Present value. C. Nominal rate. D. Effective rate. Do you know the answer? Correct answer, B. Present value. Explanation. Option B is correct because present value calculates what future money is worth today by discounting it back using an appropriate interest rate. Option A is incorrect because future value calculates what current money will be worth later after compounding interest growth. Option C is incorrect because nominal rate is the stated interest rate, without considering compounding frequency effects on value. Option D is incorrect because effective rate accounts for compounding frequency, but does not directly calculate present values. Present value is one of the most powerful concepts in finance. Let me explain why. Present value answers the question, what is future money worth today? The logic is that money today can be invested to grow, so $1,000 today is worth more than $1,000 in 5 years. To find present value, we discount future cash flows using an interest rate that reflects the time value of money and risk. This is fundamentally different from future value, which compounds forward, or nominal rates, which just state an interest rate. Present value is the foundation for valuing everything from bonds to businesses because it tells us what any stream of future cash flows is worth right now. 12. Management is evaluating whether to accept a capital project. The project should be accepted only if which condition regarding net present value is met for shareholder wealth maximization. A. NPV equals 0. B. NPV is negative. C. NPV is positive. D. NPV is undefined. Can you guess the answer? Correct answer, C. NPV is positive. Explanation. Option C is correct because a positive NPV indicates the project will add value to the firm and increase shareholder wealth beyond required returns. Option A is incorrect because 0 NPV means the project only meets required return without adding additional shareholder value. Option B is incorrect because negative NPV destroys shareholder value and should result in immediate project rejection decisions. Option D is incorrect because NPV must be calculable for proper investment decisions and cannot be undefined or incalculable. Let's clarify why positive NPV is the golden rule for project acceptance. NPV, or net present value, represents the value a project adds to your company above and beyond the required return. When NPV is positive, it means the project generates returns that exceed what investors require for that level of risk. It literally creates wealth. A 0 NPV means you're just breaking even, meeting but not exceeding requirements. A negative NPV? That's value destruction. You'd be better off not doing the project at all. This is why the decision rule is so clear. Accept projects with positive NPV because they increase shareholder wealth, which is the fundamental goal of financial management. 13. Your company needs to track daily expenses by category to monitor spending against budget limits. Which personal finance method would translate best into a business expense tracking system? A. Mental accounting. B. Envelope method E. C. Pay yourself. D. Set and forget. Do you know the answer? Correct answer. B. Envelope method. Explanation: option B is correct because the envelope method allocates funds to categories and tracks daily spending, providing excellent budget control and monitoring capabilities. Option A is incorrect because mental accounting involves psychological money categorization without systematic tracking of actual spending patterns. Option C is incorrect because pay yourself focuses on savings priorities rather than comprehensive expense tracking by categories. Option D is incorrect because set and forget approaches lack the active monitoring needed for effective expense control. The envelope method isn't just about budgets, it's about psychology and control. By allocating money to specific categories up front, you're making spending decisions when you're calm and rational, not in the heat of the moment. Each category acts like a spending speed limit. You can see exactly how much you have left, creating natural friction against overspending. The daily tracking aspect is crucial because it provides immediate feedback, unlike credit cards where the pain comes later. This method transforms budgeting from an abstract exercise into a tangible visual system where you can literally see your money disappearing from each category, making you think twice before unnecessary purchases. 14. A financial analyst needs to determine the interest rate that makes a project net present value equal to 0. Which Excel function specifically calculates this break-even rate for investment decision-making? A. Rate function. B. IRR function. C. PMT function. D. FV function. Can you guess the answer? Correct answer, B. IRR function. Explanation. Option B is correct because the IRR function calculates the internal rate of return where net present value equals 0, indicating the project break-even rate. Option A is incorrect because rate calculates periodic interest rates for annuities, not the net present value break-even rate point. Option C is incorrect because PMT calculates payment amounts for loans or annuities, not interest rates or returns. Option D is incorrect because FV calculates future values of investments, not the rate that makes net present value 0. IRR, or internal rate of return, is like finding the break-even interest rate for an investment. Here's the key insight. IRR is the discount rate that makes a project's NPV exactly equal to 0. It's where the project neither creates nor destroys value. Think of it as finding the speed limit where you're going exactly as fast as allowed, not faster, not slower. IRR is particularly useful because it gives you a single percentage to compare against your required return. If your IRR exceeds your cost of capital, you're creating value. The rate function calculates periodic rates for loans, while PMT calculates payments. Only IRR finds that critical break-even rate for investment decisions. 15. WorldCom filed for bankruptcy after executives manipulated accounting procedures. This scandal primarily resulted from conflicts between which two groups with different interests in the firm? A. Customers and suppliers. B. Managers and shareholders. C. Banks and bondholders. D. Employees and unions. Do you know the answer? Correct answer, B. Managers and shareholders. Explanation. Option B is correct because the scandal arose from managers manipulating accounts for personal benefit while harming shareholders who owned the company. Option A is incorrect because customers and suppliers were affected by the bankruptcy but did not cause the accounting manipulation. Option C is incorrect because banks and bondholders are both creditors with aligned interests in company debt repayment. Option D is incorrect because employees and unions were victims of the scandal rather than parties to the conflict. The WorldCom scandal perfectly illustrates the devastating consequences of manager-shareholder conflicts. When executives manipulated accounting to boost apparent profits, they were trying to increase their bonuses and stock option values, classic self-serving behaviour. But here's the critical point. This wasn't just dishonest, it was value-destroying for everyone except the corrupt managers. Shareholders lost billions when the truth emerged and the company collapsed. Employees lost jobs and retirement savings. Creditors faced bankruptcy proceedings. This demonstrates why the manager-shareholder conflict is so dangerous. Managers have the power to destroy enormous value while enriching themselves at least temporarily before the house of cards collapses. 16. When setting up Excel for time value calculations, you enter a rate, periods, and payment data. What does the type parameter specifically indicate about the timing of cash flows? A. Currency denomination. B. Payment timing. C. Interest frequency. D. Tax treatment. Can you guess the answer? Correct answer, B. Payment timing. Explanation. Option B is correct because the type parameter specifies whether payments occur at the beginning or end of each period in calculations. Option A is incorrect because currency denomination is not specified by the type parameter in time value functions. Option C is incorrect because interest frequency is determined by the rate and period inputs, not the type parameter. Option D is incorrect because tax treatment is handled separately from basic time value of money calculation parameters. The type parameter in Excel's financial functions is small but mighty. Let me show you why it matters. This parameter controls payment timing. 0 means payments happen at the end of each period, while 1 means they happen at the beginning. This might seem trivial, but it significantly affects calculations because of compound interest. Think about rent versus loan payments. Rent is typically due at the beginning of the month, type $1, while loan payments are usually due at the end, type $0. Getting this wrong can throw off your entire calculation. It's not about currency or frequency, those are handled elsewhere. The type parameter is purely about when, within each period, the cash flow occurs. 17. A manager considering self-dealing transactions that benefit themselves over company owners is exhibiting behaviour that creates which specific type of cost for the firm? A. Transaction costs. B. Agency costs. C. Switching costs. D. Opportunity costs. Do you know the answer? Correct answer, B. Agency costs. Explanation. Option B is correct because self-dealing creates agency costs by prioritising manager benefits over owner interests, reducing overall firm value significantly. Option A is incorrect because transaction costs involve fees and expenses for completing business deals, not manager-owner conflicts. Option C is incorrect because switching costs relate to changing suppliers or systems, not internal conflicts of interest. Option D is incorrect because opportunity costs represent foregone alternatives, not costs from misaligned manager-owner interests. Self-dealing is perhaps the most direct form of agency cost, and here's why it's so damaging. When a manager engages in self-dealing, like hiring their own company as a vendor at inflated prices, they're literally stealing value from shareholders. This isn't like transaction costs, which are necessary fees for doing business, or opportunity costs, which represent foregone alternatives. Self-dealing is pure value transfer from owners to managers through abuse of position. It violates the fundamental duty of loyalty managers owe to shareholders. Every dollar extracted through self-dealing is a dollar stolen from company value, making it a textbook example of how agency costs directly harm firms. 18. Your department needs to create a budget that tracks spending across multiple categories with regular updates. Which tool would provide the most flexibility for monitoring and revising throughout the period? A. Paper ledger. B. Mental notes. C. Spreadsheet application. D. Static report. Can you guess the answer? Correct answer. C. Spreadsheet application. Explanation. Option C is correct because spreadsheet applications allow dynamic tracking, automatic calculations, and easy updates for comprehensive budget monitoring and revision capabilities. Option A is incorrect because paper ledgers require manual calculations and are difficult to update or revise efficiently. Option B is incorrect because mental notes lack the precision and documentation needed for effective budget tracking systems. Option D is incorrect because static reports cannot be updated dynamically as spending occurs throughout the budget period. Spreadsheet applications revolutionized budgeting, and here's exactly why they're superior to paper methods. First, they provide automatic calculations, change one number, and everything updates instantly, eliminating math errors and saving hours. Second, they offer dynamic visualization through charts and graphs, making patterns visible that you'd miss in rows of numbers. Third, they enable what-if analysis. You can test different scenarios instantly. Compare this to paper ledgers where every change means recalculating everything manually, or mental notes which lack any documentation. Spreadsheets combine the structure of formal budgeting with the flexibility to adapt as circumstances change. 19. An investment offers different returns based on various economic scenarios. Which financial principle explains why investors demand higher returns for accepting this uncertainty about future outcomes? A. Liquidity preference. B. Risk-return relationship. C. Purchasing power. D. Market efficiency. Do you know the answer? Correct answer, B. Risk-return relationship. Explanation. Option B is correct because the risk-return relationship principle states that uncertain investments must offer higher expected returns to compensate for risk. Option A is incorrect because liquidity preference relates to the desire for easily convertible assets, not return requirements based on uncertainty. Option C is incorrect because purchasing power concerns inflation effects on money value, not investment uncertainty compensation requirements. Option D is incorrect because market efficiency describes how quickly prices reflect information, not the fundamental principles of risk compensation. The risk-return relationship is the bedrock principle that explains investor behavior. Here's the fundamental truth. People are naturally risk-averse. They prefer certainty to uncertainty. So to convince someone to accept uncertainty, you must offer them something extra, a risk premium. This isn't about liquidity, which is how easily you can sell something, or purchasing power, which relates to inflation. It's about the universal human tendency to demand compensation for bearing risk. The more uncertain the outcome, the higher the return investors require. This principle governs everything from why startups must offer higher returns than government bonds to why volatile stocks have higher expected returns than stable ones. 20. Your firm wants to calculate the present value of an annuity with payments starting immediately. Which Excel parameter would you adjust from 0 to 1 to reflect this payment timing? A. Rate parameter. B. Type parameter. C. EMPA parameter. D. Guess parameter. Can you guess the answer? Correct answer, B. Type parameter. Explanation. Option B is correct because the type parameter changes from 0 for end of period to 1 for beginning of period payment timing. Option A is incorrect because the rate parameter specifies the interest rate per period, not when payments occur within periods. Option C is incorrect because NPR specifies the total number of payment periods, not their timing within each period. Option D is incorrect because the guess parameter provides starting values for iterative calculations, not payment timing specifications. Let's master the type parameter for annuity calculations. This one detail can make or break your analysis. An annuity due, type =1, has payments at the beginning of each period, like paying rent on the first of the month. An ordinary annuity, type $0, has payments at the end, like most loan payments. The difference matters because money at the beginning of a period has an extra period to earn interest. Setting type from 0 to 1 doesn't change the interest rate or the number of periods. It purely shifts when payments occur. This timing shift can change your calculated values by a full period's worth of interest, so getting it right is crucial. 21. A company CEO manipulates accounting to maximize their bonus compensation. This action represents a failure in which aspect of corporate governance that should protect shareholder interests. A. Product quality. B. Market share. C. Ethical integrity. D. Brand recognition. Do you know the answer? Correct answer, C. Ethical integrity. Explanation. Option C is correct because manipulating accounting violates ethical integrity by deceiving shareholders and prioritizing personal gain over honest financial reporting standards. Option A is incorrect because product quality relates to goods and services provided, not financial reporting or governance issues. Option B is incorrect because market share measures competitive position, not the honesty of internal financial reporting practices. Option D is incorrect because brand recognition involves customer awareness and perception, not internal governance and ethics failures. Accounting manipulation for bonuses represents a critical breach of ethical integrity that goes far beyond simple dishonesty. When a CEO manipulates numbers to maximize their bonus, they're committing fraud against the very people who hired them, the shareholders. This violates ethical integrity because financial statements are supposed to be truthful representations of company performance. Investors, creditors, and employees all make decisions based on these numbers. When executives lie about performance, they're not just breaking rules, they're destroying the trust that makes capital markets function. Every stakeholder suffers. Investors lose money, employees lose faith, and the entire system's credibility erodes. 22. When using financial ratios for analysis, what is the primary purpose of comparing a company's current ratios to industry benchmarks and historical performance trends? A. Tax planning. B. Context evaluation. C. Legal compliance. D. Marketing strategy. Can you guess the answer? Correct answer, B. Context evaluation. Explanation. Option B is correct because comparing ratios to benchmarks and trends provides context for evaluating whether current performance is improving or concerning. Option A is incorrect because tax planning involves strategies to minimize tax obligations, not ratio comparison analysis methods. Option C is incorrect because legal compliance ensures adherence to regulations, separate from financial performance ratio analysis purposes. Option D is incorrect because marketing strategy focuses on customer acquisition and retention, not financial ratio evaluation contexts. Context evaluation through ratio comparison is like giving your financial metrics meaning through perspective. A current ratio of 2.0 means nothing in isolation. Is it good or bad? You only know by comparing it to industry benchmarks and your own historical trends. If your industry average is 1.5, you're doing well. If you were at 3.0 last year, you might have a problem. This isn't about tax planning or legal compliance. Those are different concerns entirely. Context evaluation transforms raw numbers into actionable insights by showing whether you're improving or declining, and whether you're ahead or behind your peers. Without context, ratios are just meaningless numbers. 23. An analyst needs to determine how much to save monthly to accumulate a specific amount for retirement. Which Excel function would calculate this required periodic savings amount most effectively? A. NPV function, B. PMT function, C. IRR function, D. Rate function. Do you know the answer? Correct answer, B. PMT function. Explanation. Option B is correct because the PMT function calculates periodic payment amounts needed to reach a future value goal given specific conditions. Option A is incorrect because NPV calculates net present value of cash flows, not required periodic payment amounts needed. Option C is incorrect because IRR determines rate of return on investments, not periodic savings amounts for goals. Option D is incorrect because rate calculates interest rates earned, not payment amounts required for savings goals. The PMT function is your retirement planning calculator, and here's exactly how it works. PMT calculates the periodic payment needed to reach a specific financial goal, given your interest rate and time horizon. Imagine you want to accumulate $500,000 for retirement in 20 years, earning 7% annually. PMT tells you exactly how much to save each month. This is different from NPV, which values cash flows, or IRR, which finds rates of return. PMT specifically solves for the payment amount in an annuity structure. It's the function that answers, how much do I need to save regularly? Which is perhaps the most practical question in personal finance. 24. Your manager asks about the fundamental principle that money received today has greater value than the same amount received in the future. What concept explains this financial principle? A. Depreciation method, B. Inventory valuation, C. Time value, D. Revenue recognition. Can you guess the answer? Correct answer, C. Time value. Explanation. Option C is correct because the time value of money principle states that money available today is worth more than the same amount in the future due to its potential earning capacity. Option A is incorrect because depreciation method allocates the cost of an asset over its useful life and is not related to the principle of money having different values at different times. Option B is incorrect because inventory valuation is the process of determining the cost associated with a company's inventory and does not address the core concept of present versus future value. Option D is incorrect because revenue recognition is an accounting principle that determines when revenue is recorded and reported, and it does not directly relate to the difference in value of money over time. Time value of money is the foundation of all financial thinking. Let me explain why it's so powerful. The core principle is simple. Money today is worth more than the same amount in the future because of its earning potential. If you have $100 today, you can invest it and have $110 next year. Therefore, $100 today equals $110 next year, not $100. This principle drives every financial decision from mortgages to retirement planning. It's not about depreciation of assets or inventory valuation. Those are accounting concepts. Time value is about the fundamental relationship between present and future money, making it the single most important concept in finance. 25. A firm discovers managers are purchasing unnecessary companies to expand their personal power base. This behavior creates costs that directly conflict with which primary business objective? A. Employee satisfaction, B. Shareholder wealth, C. Community service, D. Environmental protection. Do you know the answer? Correct answer, B. Shareholder wealth. Explanation. Option B is correct because unnecessary acquisitions for personal power waste resources that should maximize shareholder wealth, the firm's primary financial objective. Option A is incorrect because employee satisfaction, while important, is not the primary objective violated by unnecessary acquisitions. Option C is incorrect because community service represents corporate social responsibility, not the main objective of wealth maximization. Option D is incorrect because environmental protection is a sustainability concern, not the primary financial objective being violated. Unnecessary acquisitions for personal power represent a classic agency problem that directly attacks shareholder wealth maximization. When managers buy companies not for profitability, but to build their empire, they're using shareholder money to increase their own prestige and compensation. Larger companies typically pay executives more, so managers have personal incentives to grow, even through value-destroying acquisitions. This directly conflicts with shareholder wealth maximization, the primary goal of any corporation. Every dollar spent on an unnecessary acquisition is a dollar that could have been returned to shareholders or invested in profitable projects. This is why board oversight of major acquisitions is so critical. 26. Your company needs to forecast next quarter's cash flows using historical patterns. Which budgeting approach would best incorporate past data trends into future financial projections? A. Zero-based. B. Historical analysis. C. Activity costing. D. Incremental method. Can you guess the answer? Correct answer, B. Historical analysis. Explanation. Option B is correct because historical analysis uses past data patterns and trends to project future performance and cash flow expectations accurately. Option A is incorrect because zero-based budgeting ignores historical data and builds budgets from scratch each period. Option C is incorrect because activity costing focuses on cost drivers rather than using historical trends for forecasting. Option D is incorrect because incremental method makes simple percentage adjustments without analyzing underlying historical data patterns. Historical analysis for forecasting is like being a financial archaeologist. You dig through past data to predict the future. This approach recognizes that business patterns tend to repeat: seasonal sales cycles, customer payment behaviors, expense patterns. By analyzing what happened last January, last quarter, or last year, you can make educated predictions about what's coming. Zero-based budgeting ignores this valuable history and starts fresh, while activity costing focuses on cost drivers. Historical analysis says the past is prologue. If sales grew 15% annually for 5 years, that trend likely continues unless something fundamental changes. It's data-driven forecasting at its most practical. 27. An investor evaluating two projects with identical returns should prefer the one with lower risk. This decision rule directly applies which fundamental investment principle? A. Diversification benefit. B. Risk-return trade-off. C. Market timing. D. Technical analysis. Do you know the answer? Correct answer, B. Risk-return trade-off. Explanation. Option B is correct because the risk-return trade-off principle indicates that rational investors prefer lower risk when returns are equal. Option A is incorrect because diversification benefit relates to portfolio risk reduction through multiple investments, not project selection. Option C is incorrect because market timing attempts to predict price movements, not evaluate risk-return relationships directly. Option D is incorrect because technical analysis studies price patterns and trends, not fundamental risk-return decision principles. The risk-return trade-off creates a simple but powerful decision rule for choosing between investments. When two projects offer identical returns, any rational investor chooses the one with lower risk. This is just common sense. Why accept more uncertainty when you can get the same reward with less? This principle isn't about diversification, which spreads risk across multiple investments, or market timing, which tries to predict price movements. It's about the fundamental logic that guides every investment decision. Minimize risk for a given return, or maximize return for a given risk. This binary choice, same return, different risk, makes the decision crystal clear. 28. Management compensation through stock ownership helps reduce agency costs. What is the primary reason this alignment mechanism effectively motivates managers to maximize firm value? A. Tax advantages. B. Direct incentive. C. Accounting benefits. D. Liquidity provision. Can you guess the answer? Correct answer, B. Direct incentive. Explanation. Option B is correct because stock ownership gives managers a direct stake in the company's success, aligning their interests with those of the shareholders and motivating them to make decisions that increase firm value. Option A is incorrect because tax advantages are a secondary benefit, not the primary driver of alignment between manager and shareholder interests. Option C is incorrect because accounting benefits are not directly related to aligning managerial behaviour with shareholder goals through stock ownership. Option D is incorrect because liquidity provision refers to the ease of converting assets to cash and is not directly related to aligning management incentives with shareholder value. Stock ownership compensation is the most direct way to transform managers into owners, creating powerful psychological and financial alignment. When managers own shares, every strategic decision affects their personal wealth. If the stock rises 20%, so does their net worth. This direct incentive is fundamentally different from tax advantages, which are secondary benefits, or liquidity provision, which is about converting assets to cash. The magic happens because stock ownership makes long-term value creation personally profitable for managers. They stop thinking like employees collecting paychecks and start thinking like owners building wealth. It's incentive alignment in its purest form. 29. Your supervisor needs to calculate the future value of current investments. Which Excel function would properly compute what today's money will be worth at a future date? A. PV function. B. FV function. C. NPV function. D. PMT function. Do you know the answer? Correct answer, B. FV function. Explanation. Option B is correct because the FV function calculates future value by compounding present amounts forward at specified interest rates over time. Option A is incorrect because PV calculates present value by discounting future amounts backward, not compounding forward values. Option C is incorrect because NPV calculates net present value of multiple cash flows, not single future value amounts. Option D is incorrect because PMT calculates periodic payment amounts for annuities, not future values of current investments. The FV or future value function is your financial time machine, showing what today's money becomes tomorrow. FV takes your current amount and compounds it forward at a specified interest rate for a given number of periods. If you invest $1,000 today at 5% for 10 years, FV calculates that it becomes $1,629. This is the opposite of PV, which discounts backward, and completely different from NPV, which evaluates projects, or PMT, which calculates payments. FV answers one specific question: what will my money grow to? It's essential for retirement planning, education savings, and any situation where you need to know the future value of current investments. 30. A financial analyst discovers that company executives are manipulating financial statements to optimize their bonuses. This unethical behavior primarily violates responsibilities to which stakeholder group? A. Competitors. B. Shareholders, C. Suppliers, D. Government. Can you guess the answer? Correct answer, B. Shareholders. Explanation. Option B is correct because manipulating statements deceives shareholders who rely on accurate financial information for investment decisions and company evaluation purposes. Option A is incorrect because competitors are external parties, not directly harmed by internal financial statement manipulation practices. Option C is incorrect because suppliers focus on payment reliability rather than internal financial reporting accuracy for bonuses. Option D is incorrect because while the government enforces regulations, shareholders are the primary victims of financial manipulation schemes. Financial statement manipulation to optimize bonuses is fraud, pure and simple, with shareholders as the primary victims. When executives cook the books, they're lying to the very people who own the company and rely on accurate information to make investment decisions. Shareholders aren't just numbers, they're retirees depending on dividends, families saving for college, pension funds managing workers' futures. When false financials inflate stock prices temporarily, shareholders buy at inflated prices and lose massively when truth emerges. While regulators enforce laws and competitors watch markets, shareholders bear the direct financial loss from this deception. They trusted, and that trust was betrayed. 31. When creating a personal budget using spreadsheet software, what is the primary advantage of connecting bank accounts for automatic transaction updates? A. Privacy protection. B. Real-time tracking. C. Cost reduction. D. Storage capacity. Do you know the answer? Correct answer, B. Real-time tracking. Explanation. Option B is correct because automatic bank connections enable real-time expense tracking and categorization without manual data entry delays or errors. Option A is incorrect because connecting accounts actually reduces privacy by sharing data, not protecting it better. Option C is incorrect because bank connections may involve fees rather than reducing costs of budget tracking systems. Option D is incorrect because storage capacity relates to data volume limits, not the benefits of automatic transaction updates. Connecting bank accounts to budgeting software revolutionizes expense tracking through real-time automation. Instead of manually entering every coffee purchase or grocery trip, transactions flow automatically into your budget categories within hours or minutes. This real-time tracking means you always know exactly where you stand. No surprises at month's end. It's not about privacy protection. In fact, you're sharing data to gain functionality. It's not about cost reduction or storage capacity either. The killer feature is immediacy and accuracy. You see that impulse purchase hit your budget immediately, creating a feedback loop that changes spending behavior. 32. Your company is evaluating a risky project that requires higher returns to compensate investors. This requirement demonstrates which fundamental principle about the relationship between risk and expected returns. A. Efficient frontier. B. Risk premium. C. Beta coefficient. D. Standard deviation. Can you guess the answer? Correct answer, B. Risk premium. Explanation. Option B is correct because risk premium represents the additional return required above safe investments to compensate for accepting higher uncertainty levels. Option A is incorrect because the efficient frontier shows optimal risk-return combinations for portfolios, not individual project requirements. Option C is incorrect because the beta coefficient measures systematic risk relative to the market, not the compensation principle itself. Option D is incorrect because standard deviation measures variability but does not explain the compensation requirement for risk. Risk premium is the extra return investors demand for taking on uncertainty, It's the market's price tag for risk. Think of risk premium as hazard pay for your money. Just as dangerous jobs pay more than safe ones, risky investments must offer higher returns than safe investments. A government bond might return 3% because it's virtually risk-free, but a startup investment might need to offer 25% expected return because it could fail completely. The risk premium is that extra 22%, the compensation for accepting uncertainty. This isn't about measuring risk with beta or standard deviation. It's about the fundamental principle that risk has a price. 33. An employee creating fake customer accounts violates business ethics. Beyond immediate fines and penalties, what is the most significant long-term cost to the organisation? A. Training expenses. B. Reputation damage. C. Office supplies. D. Parking fees. Do you know the answer? Correct answer, B. Reputation damage. Explanation: option B is correct because reputation damage from ethical violations destroys customer trust and confidence, causing lasting harm beyond immediate financial penalties. Option A is incorrect because training expenses are minor compared to the massive reputational harm from ethical breaches. Option C is incorrect because office supplies are trivial, operational costs unrelated to ethical violation, consequences or impacts. Option D is incorrect because parking fees are irrelevant, overhead expenses compared to reputation damage from ethical failures. Reputation damage from ethical violations is the silent killer of corporate value, invisible but devastating. When employees create fake accounts, the immediate costs are fines and lawsuits, but the real catastrophe is the erosion of trust that took decades to build. Customers don't just leave, they tell others to leave. Talented employees refuse to join a tainted company. Partners distance themselves. The brand becomes toxic. Unlike training expenses or office supplies, which are predictable operational costs, reputation damage creates a cascading failure that can persist for years or even decades. Trust once broken is nearly impossible to fully restore. 34. Your manager needs to know which Excel function calculates the interest rate when other loan parameters are known. Which function would determine the rate given payment periods and present value? And A. FV function, B. Rate function, C. Type function, D. PMT function. Can you guess the answer? Correct answer, B. Rate function. Explanation: option B is correct because the rate function is specifically designed to calculate the interest rate when the payment amount, number of periods, and present value are known. Option A is incorrect because the FV function calculates the future value of an investment, not the interest rate of a loan. Option C is incorrect because the type function specifies the payment timing within periods and does not perform interest rate calculations. Option D is incorrect because the PMT function calculates the payment amount for a loan, given the interest rate, loan amount, and number of periods. The rate function is your interest rate detective, solving for the unknown rate when you know everything else. Imagine you borrowed $10,000, pay $300 monthly for 36 months. What interest rate are you actually paying? Rate calculates this precisely. This is fundamentally different from FV, which projects future values, or PMT, which calculates payment amounts. Rate specifically finds the interest rate that makes all the other numbers work together. It's invaluable for comparing loan offers. That car dealer saying low monthly payments might be hiding a terrible interest rate. Rate reveals the true cost of borrowing. 35. A CEO is fired for allowing fraudulent accounts that harmed customers and shareholders. This consequence demonstrates accountability for failing in which critical leadership responsibility. A. Product innovation. B. Ethical oversight. C. Market expansion. D. Cost cutting. Do you know the answer? Correct answer B. Ethical oversight. Explanation: option B is correct because CEOs bear ultimate responsibility for ethical oversight and preventing fraudulent activities that harm stakeholders and company integrity. Option A is incorrect because product innovation involves developing new offerings, not preventing fraudulent account creation or activities. Option C is incorrect because market expansion focuses on growth strategies, not internal ethical compliance and oversight responsibilities. Option D is incorrect because cost-cutting involves expense reduction, not the ethical responsibility to prevent customer fraud. When a CEO is fired for allowing fraud, it demonstrates the ultimate accountability for ethical oversight failure. The CEO sits atop the organizational pyramid. They set the tone, establish the culture, and bear responsibility for systemic failures. Ethical oversight isn't just about catching fraud, it's about creating systems and cultures where fraud cannot flourish. When thousands of fake accounts are created, it's not just low-level employee misconduct, it's a leadership failure to maintain proper controls, incentives, and monitoring. The CEO's removal sends a message. Ethical failures at any level ultimately rest with leadership. The captain goes down with the ship. 36. When using the envelope budgeting method, what is the primary purpose of creating separate categories for different types of expenses? A. Tax deductions. B. Spending control. C. Interest earnings. D. Credit building. Can you guess the answer? Correct answer B. Spending control. Explanation: option B is correct because separate categories in envelope budgeting provide spending control by allocating specific amounts and preventing overspending in areas. Option A is incorrect because tax deductions require different documentation than envelope budget categories provide for spending control. Option C is incorrect because interest earnings come from investments and savings, not from categorizing expenses in budgets. Option D is incorrect because credit building depends on payment history and utilization, not expense categorization methods used. Envelope budgeting categories are all about spending control through visible limits. Each category acts like a speed governor on your spending. When you see the entertainment envelope getting empty halfway through the month, you naturally slow down. This visual feedback is powerful psychology. Abstract numbers become tangible limits you can see and feel. It's not about tax deductions or credit building. Those are different financial goals. The categories create friction against overspending because moving money between envelopes requires conscious decision-making. You can't accidentally overspend what you can visibly see you don't have. 37. Your firm needs to evaluate whether an investment project will create or destroy shareholder value. Which metric directly indicates value creation when it exceeds zero? A. Gross margin. B. Net present value. C. Current ratio. D. Inventory turnover. Do you know the answer? Correct answer B. Net present value. Explanation: option B is correct because net present value above zero directly indicates the project creates value exceeding required returns for shareholders. Option A is incorrect because gross margin measures profitability on sales, not whether projects create shareholder value overall. Option C is incorrect because current ratio measures liquidity and short-term solvency, not project value creation potential. Option D is incorrect because inventory turnover measures efficiency of inventory management, not investment project value creation. Net present value is the ultimate arbiter of value creation. When NPV is positive, you're literally creating wealth. Here's why NPV is so powerful. It considers all cash flows, accounts for the time value of money, and incorporates the required return for risk. A positive NPV means the project returns more than what investors require for that level of risk. It's excess value creation. This is totally different from gross margin, which measures sales profitability, or current ratio, which measures liquidity. NPV directly answers the question, does this investment make us richer? When NPV exceeds 0, the answer is yes. 38. A manager enters self-dealing transactions that benefit themselves over company owners. What type of cost does this behaviour impose on the firm and its shareholders? A. Fixed cost. B. Agency cost. C. Variable cost. D. Marginal cost. Can you guess the answer? Correct answer, B. Agency cost. Explanation: option B is correct because self-dealing creates agency costs by misaligning manager actions with owner interests, destroying firm value through conflicts. Option A is incorrect because fixed costs remain constant with production levels and are unrelated to manager-owner conflict costs. Option C is incorrect because variable costs change with output volume, not from conflicts between managers and owners. Option D is incorrect because marginal cost measures incremental production expense, not costs from misaligned incentives or interests. Self-dealing transactions create agency costs through the most direct form of value theft imaginable. When a manager hires their own consulting firm at inflated prices, or sells company assets to themselves below market value, they're literally transferring wealth from shareholders to their own pockets. This isn't a fixed cost that stays constant, or a variable cost that changes with production. It's pure value extraction. Every dollar of self-dealing is a dollar stolen from company value. It's the most blatant violation of fiduciary duty, where managers enrich themselves at direct shareholder expense. 39. Financial forecasting requires analysing historical data to identify patterns. What is the primary benefit of using spreadsheet templates for this analysis versus manual calculations? A. Legal protection. B. Automatic updates. C. Social networking. D. Entertainment value. Do you know the answer? Correct answer, D. Automatic updates. Explanation: option B is correct because spreadsheet templates provide automatic updates and calculations when data changes, improving accuracy and efficiency over manual methods. Option A is incorrect because legal protection comes from proper documentation and compliance, not from using spreadsheet templates. Option C is incorrect because social networking is unrelated to financial forecasting and spreadsheet analysis tools or methods. Option D is incorrect because entertainment value is irrelevant to the practical benefits of financial analysis spreadsheet templates. Spreadsheet templates transform financial forecasting from tedious calculation to dynamic analysis through automatic updates. Change one assumption, like next quarter's sales forecast, and watch every dependent calculation instantly recalculate. Revenue projections, commission expenses, inventory needs, cash flow. This automatic cascade of updates eliminates calculation errors and reveals relationships you might miss with manual math. It's not about legal protection or entertainment. It's about efficiency and accuracy. Manual calculations might take hours and introduce errors at each step. Spreadsheets do it instantly and perfectly, letting you test multiple scenarios in minutes rather than days. 40. An investor must choose between two investments with different risk levels. According to risk-return principles, which investment characteristic should increase with higher risk? A. Expected return. B. Tax rate. C. Holding period. D. Transaction fee. Can you guess the answer? Correct answer, A. Expected return. Explanation: Option A is correct because expected return must increase with risk to compensate investors for accepting greater uncertainty about future outcomes. Option B is incorrect because tax rates depend on income levels and regulations, not investment risk levels taken. Option C is incorrect because holding period reflects investment time horizon preferences, not risk compensation requirements or principles. Option D is incorrect because transaction fees relate to broker services, not the risk-return relationship in investments. The fundamental risk-return principle dictates that expected returns must rise with risk levels. This is non-negotiable in rational markets. Investors are risk-averse by nature, meaning they need compensation to accept uncertainty. The expected return is that compensation. Think of it like insurance in reverse. Just as you pay more to insure riskier activities, investments must pay you more for accepting riskier outcomes. Tax rates don't change with investment risk, nor do holding periods or transaction fees. These are separate considerations. The iron law is simple: more risk demands more return, or investors simply won't participate. 41. Your company implements stock-based compensation for managers. This strategy primarily aims to reduce agency costs by creating which type of alignment? A. Departmental goals. B. Interest alignment. C. Budget cycles. D. Office locations. Do you know the answer? Correct answer: B. Interest alignment. Explanation: Option B is correct because stock compensation aligns manager and shareholder interests by making both groups benefit from increased company value together. Option A is incorrect because departmental goals involve internal coordination, not manager-shareholder interest alignment through compensation. Option C is incorrect because budget cycles relate to planning periods, not aligning manager incentives with owner wealth. Option D is incorrect because office locations involve physical workspace, unrelated to compensation strategies for interest alignment purposes. Stock-based compensation achieves interest alignment by making managers and shareholders literally the same people. When managers own significant equity, the agency problem largely disappears because harming shareholders means harming themselves. Every strategic decision, whether to pursue an acquisition, increase R&D spending, or return cash to shareholders, now directly impacts the manager's personal wealth. This alignment is about interests, not departments or budgets or office locations. It transforms the fundamental relationship from employer-employee to co-owners. The beauty is its simplicity. When managers are shareholders, their interests automatically align. 42. When calculating time value of money in Excel, what does the payment parameter represent in the financial functions? A. Error margin. B. Periodic amount. C. Cell reference. D. File name. Can you guess the answer? Correct answer: B. Periodic amount. Explanation: Option B is correct because the payment parameter represents the periodic amount paid or received regularly throughout the investment or loan term. Option A is incorrect because error margin relates to statistical accuracy, not payment amounts in time value calculations. Option C is incorrect because cell reference indicates spreadsheet location, not the payment value itself in financial functions. Option D is incorrect because file name identifies the document, not payment parameters within time value function calculations. The payment parameter in Excel's time value functions represents the periodic cash flow amount, the regular payment in an annuity. This could be your monthly mortgage payment, annual retirement contribution, or weekly savings deposit. The payment parameter is always the same amount each period, which is what makes it an annuity rather than irregular cash flows. It's not about error margins or cell references or file names. Those are completely different concepts. The payment is the actual dollar amount flowing in or out each period. Understanding this parameter is crucial because it's the building block for loan calculations, retirement planning, and any scenario with regular payments. 43. A company faces scandal after employees created millions of fake accounts. Beyond regulatory fines, what represents the most damaging long-term consequence for the organisation? A. Paper costs. B. Trust erosion. C. Desk supplies. D. Coffee expenses. Do you know the answer? Correct answer, B. Trust erosion. Explanation: option B is correct because trust erosion with customers and the public represents lasting damage that affects business relationships beyond immediate financial penalties. Option A is incorrect because paper costs are minimal operational expenses compared to the massive trust and reputation damage caused by the scandal. Option C is incorrect because desk supplies are a trivial overhead expense unrelated to the serious consequences of account fraud. Option D is incorrect because coffee expenses are insignificant compared to the devastating impact of lost customer trust. Trust erosion from fake account scandals represents the most devastating long-term consequence because trust is the foundation of all business relationships. When customers discover accounts opened without consent, they don't just feel deceived, they feel violated. This trust erosion spreads like cancer. Existing customers leave, potential customers stay away, employees lose pride, investors lose confidence. Paper costs and coffee expenses are trivial, operational items that don't affect the business model. But trust is everything. Banks especially exist on trust. We literally trust them with our money. Once that trust erodes, the business model itself becomes unsustainable. 44. Your department needs to track actual spending against budgeted amounts daily. Which budgeting tool feature would be most critical for this continuous monitoring requirement? A. Color printing. B. Category tracking. C. Font selection. D. Page numbering. Can you guess the answer? Correct answer, B. Category tracking. Explanation: option B is correct because category tracking allows for the monitoring of actual expenses versus budgeted amounts for each spending area, which is essential for daily tracking. Option A is incorrect because color printing does not enable the tracking of actual expenses against the budget. It only enhances visual appeal. Option C is incorrect because font selection has no impact on the ability to monitor spending against budgets. It only affects readability. Option D is incorrect because page numbering does not facilitate expense tracking against budget categories. It only organizes the document. Category tracking is the heart of budget monitoring because it shows exactly where money goes versus where it should go. Each category becomes a scorecard: budgeted versus actual, variance remaining balance. You can see instantly that you've spent 80% of your food budget, but only 20% of the month has passed. Time to adjust. Color printing and font selection are cosmetic features that don't affect functionality. Page numbering organizes documents but doesn't track spending. Category tracking transforms abstract budgets into concrete, actionable information. It's the difference between hoping you're on budget and knowing you're on budget. 45. An analyst needs to determine if a project's internal rate of return exceeds the required return. What does it mean when IRR is greater than the cost of capital? A. Project rejection. B. Value creation. C. Break even. D. Value destruction. Do you know the answer? Correct answer, B. Value creation. Explanation: option B is correct because IRR exceeding cost of capital indicates the project creates value by generating returns above the required minimum. Option A is incorrect because project rejection occurs when IRR falls below required return, not when it exceeds it. Option C is incorrect because break-even occurs when IRR equals cost of capital, with no value creation or destruction. Option D is incorrect because value destruction happens when IRR is less than required return, not greater than it. When IRR exceeds the cost of capital, it's like a green light for value creation. The project generates returns above what investors require. IRR is the rate where NPV equals 0, so when IRR is higher than your required return, NPV must be positive. Think of cost of capital as the hurdle rate, the minimum acceptable return. If a project's IRR is 15% and cost of capital is 10%, the extra 5% is pure value creation, above requirements. This isn't break-even, where IRR equals cost of capital, or value destruction where IRR falls below. When IRR exceeds the hurdle, you're creating wealth. 46. Managers spending money on wasteful projects that don't benefit shareholders demonstrates which type of agency problem affecting firm value. A. Capital allocation. B. Debt structure. C. Dividend policy. D. Stock splits. Can you guess the answer? Correct answer, A. Capital allocation. Explanation: option A is correct because wasteful spending represents poor capital allocation decisions, where managers misuse resources instead of maximizing shareholder value effectively. Option B is incorrect because debt structure involves financing mixed decisions, not wasteful project spending by management teams. Option C is incorrect because dividend policy concerns profit distribution to shareholders, not wasteful internal project spending patterns. Option D is incorrect because stock splits adjust share quantities without changing ownership value or addressing spending issues. Wasteful project spending by managers is a capital allocation agency problem that directly destroys shareholder value. Capital allocation, deciding where to invest company money, is management's most important job. When managers waste capital on vanity projects, unnecessary perks, or empire-building acquisitions, they're misallocating resources that should generate returns for shareholders. This isn't about debt structure or dividend policy. Those are financing decisions. It's about the fundamental failure to invest capital wisely. Every dollar wasted on a negative NPV project is a dollar that could have been invested profitably or returned to shareholders. 47. Your supervisor asks about tools for creating and monitoring budgets. Which software type provides the most comprehensive features for both planning and tracking financial data? A. Photo editor. B. Spreadsheet application. C. Music player. D. Video editor. Do you know the answer? Correct answer, D. Spreadsheet application. Explanation: option B is correct because spreadsheet applications offer comprehensive budgeting features, including formulas, charts, and automatic calculations for planning and tracking. Option A is incorrect because photo editors manipulate images, not financial data for budget planning and monitoring purposes. Option C is incorrect because music players handle audio files, completely unrelated to financial budgeting and tracking needs. Option D is incorrect because video editors process video content, not numerical financial data for budget management systems. Spreadsheet applications dominate budget management because they combine computational power with visual flexibility. Unlike photo editors that manipulate images or music players that handle audio, spreadsheets are purpose-built for numerical data. They offer formulas that automatically calculate totals, averages, and variances. They provide charts that visualize spending patterns. They enable pivot tables that summarize data from multiple angles. Most importantly, they create living documents that update dynamically as you input new data. This combination of calculation, visualization, and adaptation make spreadsheets the Swiss Army knife of financial planning. 48. When interest rates increase, what happens to the present value of future cash flows according to time value of money principles? A. Remains constant. B. Becomes undefined. C. Decreases proportionally. D. Increases proportionally. Can you guess the answer? Correct answer, C. Decreases proportionally. Explanation. Option C is correct because higher interest rates reduce present value, because future cash flows are discounted more heavily when rates increase. Option A is incorrect because present value changes inversely with interest rates, not remaining constant when rates change. Option B is incorrect because present value remains calculable with defined rates, never becoming undefined or incalculable mathematically. Option D is incorrect because present value moves inversely to rates, decreasing when rates rise rather than increasing together. Higher interest rates decrease present value, and this inverse relationship is fundamental to finance. Here's the intuition. Present value asks, what's future money worth today? When interest rates rise, you can earn more by investing today's money, so future money becomes less valuable by comparison. If rates jump from 5% to 10%, that $1,000 you'll receive in 5 years is worth much less today, because you'd need less money now to grow to $1,000 at the higher rate. This relationship never stays constant or becomes undefined. It's a mathematical certainty. Higher rates always mean lower present values. 49. A financial manager must decide between projects with different risk profiles. What principle suggests accepting higher risk only when accompanied by sufficiently higher expected returns? A. Conservation principle. B. Risk compensation. C. Historical cost. D. Going concern. Do you know the answer? Correct answer, B. Risk compensation. Explanation. Option B is correct because the risk compensation principle requires higher expected returns for higher risk projects to justify the additional uncertainty accepted. Option A is incorrect because the conservation principle involves cautious accounting estimates, not risk-return relationships in investments. Option C is incorrect because historical cost records assets at purchase price, unrelated to risk-return decision principles. Option D is incorrect because going concern assumes business continuity, not the relationship between risk and required returns. Risk compensation is the principle that drives rational investment decisions. You only accept higher risk when adequately compensated with higher expected returns. This isn't about being conservative or recording historical costs. It's about the fundamental logic of risk and reward. No rational investor accepts extra risk for free. If a safe investment offers 5% and a risky one also offers 5%, everyone chooses safety. The risky investment must offer perhaps 12% to attract investors. That extra 7% is risk compensation, the premium for accepting uncertainty. This principle ensures capital flows to its most productive uses while properly pricing risk. 50. Your company discovers executives manipulated accounting for personal bonuses while destroying shareholder value. This violation of fiduciary duty represents failure. In which governance area? A. Marketing strategy. B. Ethical leadership. C. Product design. D. Supply chain. Can you guess the answer? Correct answer, B. Ethical leadership. Explanation. Option B is correct because manipulating accounting for personal gain represents ethical leadership failure by prioritizing self-interest over shareholder trust. Option A is incorrect because marketing strategy involves customer communication, not internal governance and ethical compliance issues. Option C is incorrect because product design relates to development processes, not executive ethical responsibilities to shareholders. Option D is incorrect because supply chain manages vendor relationships, unrelated to executive accounting, manipulation, and ethics. Executive accounting manipulation for personal bonuses represents the ultimate ethical leadership failure, destroying the trust foundation of capitalism itself. When leaders who should exemplify integrity instead commit fraud for personal gain, they don't just steal money, they corrode the entire system. Shareholders invest based on financial statements they trust. When executives deliberately falsify these statements, they're not just breaking laws or violating ethics, they're undermining the very basis of public markets. This isn't about marketing or product design or supply chains. It's about the sacred trust between corporate leaders and the investors who fund American business. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.